Hi everyone. We are now going to review problem 18-5 on page 1092 of your book. So, in our chapter, we're dealing with shareholders' equity and some of the basic information about it. In chapter 19, we're going to focus on some very unique and in more advanced areas when it comes to shareholders' equity for corporations. Let's take a look. Listed below are the transactions that affected the shareholders' equity of Branch Rickey Corporation during the period 2021 to 2023. At December 31st, 2020, the corporation's accounts started with common stock, 105 million shares at $1 par for $105 million. Paid-in capital in excess of par, $630 million. And then retained earnings, $970 million. We need to prepare the journal entries that Branch Rickey recorded during the 3-year period for these transactions. Then we're going to create a comparative statement of shareholders' equity for Branch Rickey for those 3-year periods. So great review of shareholders' equity statement and the common transactions that you saw during this chapter. So let's take a look at A. November 1st, 2021, the Board of Directors declared a cash dividend of 80 cents per share on its common shares, payable to shareholders of record November 15th, to be paid December 1st. So the first thing you need to remember is that when it comes to dividends, there are 3 key dates. 1, the declaration date, which would be November 1st, that's the day the Board of Directors says they're going to pay a dividend. Now, when it's a cash dividend, as it is here, that's the day the corporation the Board of Directors binds the corporation to pay a dividend, cash. Since they're binding them to pay cash, that's the day a liability is created. So let's take a look at the journal entry. The corporation will debit retained earnings for the total amount of the dividend, 105 million shares. Dividends are calculated on outstanding shares of stock. Just to review very quickly, 3 ways to describe stock. Authorized is the maximum shares the corporation can sell in their corporate charter. Issued are the amount of shares issued to everyone, even the corporation itself, treasury stock. Outstanding are the issued shares minus the treasury shares the company owns of itself. It's the outstanding shares of stock that receive a dividend. So 105 million shares times 80 cents a share, the total amount of cash that will be paid, 84 million. It's not being paid today. It's just saying we're going to pay it in the future. So today, after we debit retained earnings to reduce the earnings available to be paid as a dividend, we credit cash dividends payable, a liability account. Now the date of record, which is November 15th, that's an administrative date. That's the ownership cutoff date. So stockholders who own the stock on November 15th will receive the cash dividend. No journal entry is necessary. But on December 1st, when the dividend is paid, now we have the ultimate payment date. So the liability that was created on the date of declaration will be debited. Cash dividends payable, debit 84 million. The cash is being sent out, credit cash. So that was a great review of the 3 major dividend dates and declaring and paying a cash dividend. The next transaction, March 1st, 2022, the next year, the Board of Directors declared a property dividend. So another dividend, but it's not a dividend with cash, but another asset. So we call it a property dividend. Still a dividend. It consists of corporate bonds of Warner Corporation that Branch Rickey holds as an investment. So they're going to pay one of their investments out as a dividend. The bonds had a fair value of $1.6 million, but were purchased 2 years previously for $1.3. Because they were intended to be held to maturity, the bonds had not been previously written up to fair market value. The property dividend was payable to the shareholders of record, so there's our record date, March 13th, and the property was distributed to the shareholders as a dividend on April 5th. So now let's take a look at the same type of dates, but the journal entries, when instead of paying cash out, you promise another asset the corporation owns, such as investments in other companies. First of all, the first thing the company will need to do is write the investment that they're giving out as a dividend, so the asset up or down to fair value on the date of declaration. So since these investments have a higher value than what they are on the books of Ritchie, they're going to debit the investment in equity securities for $300,000. Well, that should be debt securities because they're bonds. So that should be debt securities, which is fine. But they'll debit that for the difference, $300,000, and they'll recognize the gain on investment. So that's always the first step. Write the asset up or down to fair market value that you're paying as a dividend. Then record the dividend. We always record the dividend at the property's fair value. So debit retained earnings, $1.6 million, the fair value of those investments being given as a dividend. Credit the liability account, property dividends payable. Now we're not crediting the investment account yet because we did not send out the investment as a dividend yet. On the day of payment, April 5th, now we'll debit property dividends payable for 1.6 and credit the investment in equity securities because now we're physically sending those securities. As I said, it should say debt securities because it's bonds that they're actually sending out as a dividend. But remember, it's not Ritchie's bonds, but bonds of another corporation that they own as an investment. So this was one of Ritchie's assets that they sent out besides cash as a dividend. So another practice of a dividend. Let's take a look at the next transaction, which is still another practice of a dividend. July 12, 2022, the corporation declared and distributed a 5% common stock dividend when the market value of the stock was $21 a share. In lieu of fractional shares representing 250,000 equivalent whole shares. Now, the corporation isn't promising all cash here. They're saying, we're going to pay out our own stock now as a dividend. We call this a stock dividend. Up above, they were paying out an asset they owned, which was an investment in another company. Here, we're sending out our own stock. So Ritchie's paying its own stock as a dividend. Companies will do this for a variety of reasons. They may not have the cash to pay. They may want to restrict their cash. They may want to try to influence the stock price in the market. Okay, so there's many different reasons a company would send more stock, something of value to their stockholders than cash. It's up to the stockholder. Once they receive these additional shares, it's up to them if they want to trade them in and convert that to a cash dividend, because then it would be pure cash. What we want to do is first determine how much is this stock dividend worth. So your first step is, well, how many shares of stock are going to be included in this stock dividend? Notice the stock dividend is quoted in terms of a percentage of the outstanding stock. So 103 million? 105 million shares times 0.05. 5,250,000 new shares of stock are going to be sent as a stock dividend. And it looks like they were sent the same day they were declared. So when your stock dividend percentage is less than 20 to 25%, we call that a small stock dividend. And that's what this is. We need to determine a dollar value of this dividend. What we just calculated was the number of shares, but what's the shares value so we know how much to record this as a journal entry, because we can't record stock in a journal entry. We need a dollar value. So the FASB has said use the market value for these small stock dividends. So multiply that by 21. So that's where we get the 110,250,000. Now it says in the problem, they're not giving out those 250,000 shares. They're considered what we call fractional shares. They're giving out the 5 million. So determine the par value of the 5 million. It's a dollar share, par value, so 5 million. What's the total value of those 5 million? I'll take the 5 million times 21. Total value is $105 million. Well, if we put 5 million of it in the common stock representing par value, then the excess is put in paid-in capital in excess of par, the 100 million. Now the other 250,000 shares are not going to be given out as stock. Instead, the corporation said, we'll just pay that part of the dividend in cash. So 250,000 fractional shares times $21 a share. The cash portion of this dividend, 5,250,000. What you have to remember is the corporation just sent out and have issued and now outstanding additional shares of 5 million. So no longer is it at 105 million, but 110 million outstanding shares. This will impact us when we go to our next transaction, because on November 1st, 2022, the BOD declared a cash dividend of 80 cents per share on its common stock, payable to shareholders date of record November 15th, and will be paid December 1st. So now when we calculate the cash dividend, we're going to take 110 million shares times the 80 cents a share. Still debit retained earnings for the 88 million. Credit cash dividends payable, 88 million. The date of record, there's no journal entry. The date of payment, debit cash dividends payable, credit cash, just like we did in that very first transaction. Now, January 15th, 2022, the board of directors declared and distributed a 3-for-2 stock split, effected in the form of a 50% stock dividend, when the market value of the common stock was $22 per share. This is still a dividend. The impact on the market, it's like saying for every 2 shares of stock you had before, you now have 3. So it's 50% more, or a 50% stock dividend. What does the company do? There's 2 ways of accounting for this. The company can take the value, first of all, determine how many new shares of stock are being put into the market in this dividend. 110 million times 50%, 55 million. The next question is, what's the value of this dividend? It's either, so you determine the value either on the market value or the par value. Since this dividends percentage is more than 20 to 25%, it's considered a large stock dividend. Large stock dividends use par value to determine the value to record in the journal entry. I would debit retained earnings here because this is a dividend, but you also have the option of debiting paid-in capital in excess of par and crediting common stock, $55 million. Okay. Finally, in Part F, November 1st, they're declaring another cash dividend, 65 cents a share though now. Date of record is November 15th, date of payment December 1st. Remember, you just sent out even more shares of stock, 55 million more. So the total outstanding shares of stock as of the date of this dividend is 165 million. Multiply the new total by 65 cents because those are actual shares of stock that went into the market. And this is how people get value out of them. They could sell them or they own them now and they'll get dividends on them. Debit retained earnings for the total value of the cash dividend, 165 million times 65 cents a share. Credit cash dividends payable. Date of record, no journal entry. Date of payment. So great review of dividends in this practice problem. Now, let's see how our shareholders' equity is affected for this 3-year period. Now, they give us the net income of the company for those 3 years. Remember, a statement of shareholders' equity reports all equity, and it's by category and how it's changed over the period of time we're looking at. This will be 3 years. So we always start with the beginning balance of each major item in our equity. This company's major items are common stock, additional paid-in capital, and retained earnings. That's the only items they have. If they had more, there would be more columns. And then we do an overall total. So there's where they started, January 1, 2021, and it's given in the book. Now let's see how shareholders' equity changed during 2021. Well, you can go back up and use your journal entries here. So in 2021, retained earnings decreased 84 million for the dividend. And in the book, they tell us net income was 330 million. So common stock nor additional paid-in capital changed, so it still has the same balance. We add net income, subtract the dividend, and we get a new balance in retained earnings and an overall total change. During 2022, though, we had more items affecting our shareholders' equity. The first was the reduction to retained earnings due to that property dividend of 1.6 million. So this is up here. Here it is, right there. Let's take a look at what else. Oh, we had a stock dividend. It increased common stock, paid-in capital in excess of par, but decreased retained earnings. And then the final item was a cash dividend, which decreased retained earnings. So there they are. There's your stock dividend, decreasing retained earnings, but increasing additional paid-in capital in common stock. So the overall decrease to stockholders' equity from this was $5,250,000. Yeah, the value of the cash portion of the dividend. Net income increased. There's the cash dividends decreasing. So now our common stock is up to 110 million. Additional paid-in capital, 730 million. Retained earnings new balance is 1,411,150. And then we showed the total impact in our total column. finally, the last year. Now, this will depend on where you recorded your stock dividend. I'm a stickler for retained earnings, but it'll either be a decrease to additional paid-in capital or decrease to retained earnings, increase to common stock. Net income increases retained earnings. The cash dividend from up here, right there, that very last one, will decrease retained earnings. Now, at the end of the last year, common stock has a balance of 165 million. Paid-in capital will either be at 730 or 675, depending on where you recorded your decrease. Retained earnings will either be at 1,758,900, or if you're like me and record that stock dividend of 55 million in retained earnings, it'll be at 1,703,900. The key here is that no matter where you recorded this, the overall total balance in stockholders' equity will be 2,598,900. The individual columns may be different, but the total will be the same. Okay, so that is, like I said, a great review of a portion of our chapter on dividends. So please post any kind of questions or other questions on any of the other parts of the chapter to the discussion board.